Welcome to The Explainer. Today we're diving into the surprisingly complex world of construction accounting. Getting this stuff wrong isn't just a small mistake. It can create billion-dollar problems, cause companies to collapse, and make investors lose a ton of money. So let's just jump right in with the big question that haunts every single major construction project. If you're spending money for years, literally years, before you see a single dollar of revenue, how do you measure success? How do you prove to your bank or to your investors that you're not just burning through a giant pile of cash? I mean, think about building a massive bridge, right? For years, you are just pouring concrete and erecting steel, spending millions and millions of dollars. The entire time, your books just show this huge outflow of cash. But the big payday? That doesn't come until the very, very end. So what you end up with is this huge mismatch. If you use traditional accounting, a perfectly healthy, totally profitable construction company could look like it's failing for years on end. And this isn't just some reporting issue. It can make it impossible to get loans, to attract investors, or even to figure out what the business is actually worth. So to solve this pretty massive problem, the industry came up with something really smart, a special toolkit. It's basically a set of accounting methods designed specifically for the unique challenges of long-term construction. So we're going to pop open this kit and take a look at the three main tools inside. Each one is designed for a different type of job, from a small home renovation all the way up to a mega project. All right, let's start with the first and honestly the simplest tool in our kit, the cash method. The logic here is about as straightforward as it gets. You record income only when cash actually hits your bank account, and you record an expense only when you've actually paid the bill. Money in, money out. That is it. So check this out. See how it plays out in a real project. This company spends money for 2 whole months, but on paper, its books show zero profit. Then, suddenly, in March, when that final payment from the client lands, all of the profit for the entire job appears at once. So you see the problem, right? It's super simple, and it's great for tracking your actual cash flow. But man, it gives you a totally warped picture of a project's financial health while it's in progress. That's why it's really only good for small jobs with a quick turnaround. Okay, so for those huge multi-year projects, we obviously need something way more sophisticated. And that brings us to the real star of the show, the percentage of completion method, or PCM. What this method does, and this is the genius of it, is it matches the money story to the actual construction story. Instead of waiting till the end, it lets a company recognize a piece of the revenue and profit in direct proportion to how much work has actually been done. All right, let's walk through an example step by step. First, you need to know how much has been spent so far. In our example, let's say the company has spent 4 million pesos to date on labor, materials, you name it. Okay, next up, you need the big number, the total estimated cost for the entire project, from start to finish. And for this project, the team figures that number is going to be about 10 million pesos. Okay, so we've got our two key numbers. You take the 4 million you've spent so far, and you divide it by the total estimated cost of 10 million. And boom, that simple math tells you the project is exactly 40% complete. This is the core logic of PCM. You tie progress directly to your costs. And here's where the magic happens. Because you know the project is 40% complete, you get to officially recognize 40% of the total contract revenue right now. This gives everyone a true real-time picture of the economic activity that actually happened that year. So you can see the power here, right? Its biggest strength is how accurate it is. But, and this is a big but, that's also its greatest weakness. The entire system hinges on having really, really accurate estimates. If those estimates are wrong, you're not just messing up your profit numbers. You could be misleading investors or even violating your loan agreements. So what happens if you just can't? What if you can't reliably estimate your costs or measure your progress? Well, that's where our final tool comes into play, the completed contract method. This is like the ultra-conservative, super cautious approach. You basically pile up all your costs and your billings on the balance sheet, but you don't recognize a single dollar of revenue or profit until the project is 100% done and handed over to the client. So look at this 3-year highway project. For 2 straight years, the company is spending millions of pesos, but on paper, zip, nada, zero profit is recorded. Then, bam, in 2027, the entire project's revenue and profit hit the books all at once. So with these 3 very different methods, How on earth does a company choose the right tool for the job? Let's break it all down. It really just comes down to the nature of the project. You've got a quick, simple job, cash basis is your friend. A big, long-term project where you can actually measure your progress, percentage of completion is the gold standard. But if things are super uncertain and you can't make good estimates, well, the completed contract method is your safest bet. So, what's the big takeaway here? I think it's that the next time you see a crane on the skyline, remember that behind that physical structure, there's a financial structure being built right alongside it. And the accounting is just as carefully engineered as the steel and concrete. You gotta ask yourself, what kind of financial story is being told here? Is it a simple cash in, cash out story? Is it a tale of steady, measured progress year after year? Or is it a big, dramatic story where we don't find out the ending until the very last page? The choice of accounting method really tells you a lot.